Value stocks are coming off a year of underperformance, lagging growth stocks sharply in 2024, rising just 10%. Our next guest says growth names are overvalued, and he's got a shopping list of value plays for 2025. Joining us now is Ariel Investments Vice Chairman Charlie Bobrinskoy. Charlie, Happy New Year. Great to have you back on. Let's start right there. And the fact that, once again, 2024 was a strong year for growth. We certainly saw it in the number of companies that swelled into the trillion-dollar club, if you will. How does that position us for value? Where do you see value now?
So like any good value investor, I'm not going to say I know what's going to happen in the short term, but what we do know from history is that the best predictor of future performance over the 5-7 year time frame is forward multiples. That when markets are trading at reasonable multiples, you tend to get reasonable performance over the next 5 to 7 years. When things are at high multiples, you tend to get pressured returns. And that would indicate that value is set up pretty well. Large cap value set up pretty well. Large cap growth not set up well. So large cap growth trading at big premiums to their historic run rates. They are very popular right now. Value is very much out of favor. That makes us feel good, but I'm going to acknowledge I have said this for the last couple of years, and growth has continued to outperform.
So where specifically do you see value, and value that is not value traps? And I ask that knowing also that we've had a pretty strong run in the dollar, and perhaps that puts small and mid-cap stocks in bigger focus.
So there are a couple of sectors that haven't kept up, where total production and capacity has been below historic averages. Number one is housing. America is not building the houses that it has historically or that we need, and a lot of that has been regulatory. A lot of that has been interest rates. And so I think both of those things are going to get better this year. We've got housing names trading at very attractive prices when I think we're going to get an increase in both new construction and sale of existing homes. So that would be number one. We love names like Mohawk and Residio, the thermostat company. The second is going to be regional banking. The regulatory environment has been terrible for mergers. An inverted yield curve is terrible for regional banks. Regional banks tend to borrow short and lend long, and so an inverted yield curve is just brutal. That's going to get better, and we're going to see for the first time some takeovers, we think, in regional banking. We love Bank of Oklahoma is my favorite name in that space, and Northern Trust would probably be next. And then the other out-of-favor space is consumer staples, some names like Smucker's that make Hostess and Twinkie products that right now people are worried about what Kennedy might do to those companies, and we think that's going to be temporary, and people are going to keep eating their Twinkies and Ho-Hos.
Charlie, have you explored the possibility that there's a structural shift in the U.S. economy, maybe global economy, where more value is accruing to digital players and more of the digital plays are being made by larger companies, and the effect of that on value?
That's the best argument for why growth is outperforming, that this time is different. That this time there's something fundamental going on in the market that's going to make the higher valuations for growth stocks work out in the end. And we're always skeptical of that. People obviously said that in the 70s when digital computers and big mainframes were coming in and the Nifty 50 stocks got so expensive. We don't think that fundamentally is going to change, and that there are a lot of smaller companies that are benefiting from digital changes in the economy. But you're absolutely right, and I don't want to downplay this. I've said this for the last couple of years, and these digital AI stocks have continued to do well, so that it's very hard to time this.
If we are in sort of a new digital robber baron era where scale and ability to control, and if not monopoly power, just outsized power matters particularly, does that affect how long it takes value stocks to come back stronger?
I think value stocks can do okay in that environment with the productivity improvements that come from digital and AI. And of course, I'm going to point you to my favorite digital stock, which is Oracle, still trading at a sub 20 PE, and the dominant player in data software, which is going to do very well in an AI world. But you're absolutely right. Small companies and value stocks are not going to be the dominant players in AI, but they can be a big beneficiary. We have names in banking that are going to take costs out. We have names like FAF, which are going to take costs out. So smaller companies can be big beneficiaries while the large companies fight it out amongst themselves.